Ladies and gentlemen, welcome back to Invest with Henry. In this video, we're going to be walking through 7 basics of option trading. Whether you're a beginner or an experienced option investor or trader, there's something here for everyone. Stick around until the end because I have a bonus tip that took me a really long time to grasp. I've been option trading for 10 years now. It accounts for a majority of my wealth. I have so many tips for you that are going to take your game to the next level. So let's dive into the top 7 things that you must know if you're investing with options. Up front, I have a simple question for you guys. What do you think is the most important thing to know when investing with options? Leave your thoughts in the comment below. And let's start with the very first basic lesson 1. An option is a contract. The first thing that you need to know about options is that an option is simply a contract between two parties, the buyer and the seller. You are not investing directly in the company when buying or selling option contracts. Instead, you're trading the contracts and you're taking possession of a contract that you're buying, or you're giving someone the possession of a contract when you're selling. The contracts don't necessarily represent any ownership in the company. The contract is simply a bet on the stock moving either up or down, depending on if it's a call or a put option. And it's also a simple contract of, do you take ownership of the shares or do you release ownership of the shares? The concept is fundamental, but often very misunderstood. Many people that are new to option trading think they're buying a piece of the company, similar to buying a stock. Option trading is like the sauce or the cream or the icing on the cake of a stock. It adds income to the stock. It gives you the ability to hedge the stock, but is not a direct ownership in the company. However, with options, you're dealing with a derivative, which is the value of the option. It just means that it's derived from the value of the stock. So that's what a derivative is. Back to calculus class, but you don't have to be good at all to understand a derivative just means that it changes based on the stock changing. So one crucial aspect to remember that you can always sell the contract before expiration. Many people ask, Henry, do I have to hold my option contract until expiration date? And the answer is no. You can buy and sell these contracts anytime before they expire. I mean, you can actually buy an option and then sell it within a minute or 2 minutes or 5 or 10 minutes. You can buy an option and sell it the next day, the next week, the next month, or you can hold it out until a 6-month expiration. You have so much flexibility when you're trading options. And this flexibility is one of the key advantages of option trading, allowing you to manage your investments actively or passively as you see fit with your stock position or as you see fit with your lifestyle. For instance, let's say that you bought a call option thinking the stock would go up, but then something unexpected happens in the market and you decide that it's basically no longer a good investment. You can sell that call option before it expires, potentially cutting your losses or locking in gains that you may have made. This ability to exit a trade early is a powerful tool in your trading arsenal. You have the flexibility as you wish. Now, number 2 is understanding contract characteristics. Okay, let's get into the nitty-gritty of option contracts. Each option contract has 3 key features. Okay, one option contract controls 100 shares. It gives you so much power and control. By just buying one option, it's always equal to 100 shares. This means that when you buy or sell one option contract, you're dealing with the equivalent of 100 shares of strength or value or power or control, right? So for example, if you're looking at an option on NVIDIA, buying one contract means that you control 100 shares of NVIDIA. The leverage can amplify both gains and as well as losses. However, even though you're experiencing large losses, like 100% of the option, if you're buying a call option, it's actually still okay because oftentimes you can buy a call option for just a couple $100, whereas buying 100 shares would be $10,000 or more. So it's really interesting to look at the risk and return of options. Now, the next thing that you need to know. Now, next we have strike price. This is the price at which the option can be exercised. It represents the potential future value of the stock. When you look at an option chain, the strike prices are listed and you choose based on where you think the stock will go. For instance, if you believe a stock currently trading at $50 will go up to $60, you might buy a call option for just under $60, say $58. And if that is going for just $1, well, 60 minus 58 is $2, but you spent $1. So you can turn $1 into $2 in this example of a big move. So next is expiration date. Every option contract has a set expiration date, which can range from a few days to even several years in the future. So I've made videos on this talking about leap options, where you can buy really far in the future options. The further out the expiration date, the more time your investment has to potentially make money if you're buying leap options. This is known as time value of an option. Longer expiration dates give your trade more time to become profitable, but they also tend to be a lot more expensive. So it's actually a risk and return to balance, and it's a trade-off. So options that are long-term in nature have more premium, so they're more expensive, but there's a lot more time, so a lot more can happen. Understanding these characteristics is crucial because they affect how the option behaves and how you should manage your trades. For example, an option with a short time to expiration requires more precise timing, whereas a longer dated option allows more flexibility but comes at a higher cost. Now, number 3, this is one of the most important basics: calls and puts, buying and selling them. There's a very key difference here. Options are divided into calls and puts. You can either buy or sell them. That's it. There are 4 combinations: buy call, sell call, buy put, sell put. Once you get the hang of this, you can start combining them into more complex strategies like spreads and straddles and iron condors and poor man's covered calls and calendar spreads and all of the other different strategies that I do talk about on this channel. So let's break this down further. Buying a call option. This is a bullish strategy. You buy a call option when you expect the stock price to go up. This is so simple, but a lot of people don't really understand how it actually works on a deeper level. For example, if you buy a call option with a strike price of 50 and the stock goes up to 60, then your option became more valuable. However, if you bought the 61 strike price, it actually did not become more valuable at expiration because it's at 61 while the stock only goes to 60. So with the call option, you needed to go up above your strike price. Now, selling a call option. This is generally a bearish or neutral strategy. You sell a call option when you think the stock will not go above the strike price. The most common scenario is selling covered calls, where you own their underlying stock and sell call options against it to generate income. This is one of my most favorite strategies on this channel that I've talked about many times. Selling a call option should always be done on a covered basis, meaning that you have 100 shares to sell call options on those shares. Now, next is buying a put. This is a bearish strategy. You buy a put option when you expect the strike price to go down. For instance, if you buy a put option with a strike price of 50 and the stock drops to 40, your option will increase in value. Then we have selling a put. This is typically a bullish strategy. You sell a put option when you believe the stock price will stay above the strike price of the put that you sell. So oftentimes when selling put options, you just generate income on a consistent basis as long as the stock stays going sideways or up or even a little bit down. That's what makes selling a put option so powerful. These are the building blocks of option trading. By combining these basic strategies, you can generate more sophisticated trades that match your market outlook and risk tolerance. You can do so much with options because they really give you the flexibility to make quick money. They give you the flexibility to hedge the market. They give you the opportunity to make money in sideways markets, down markets, up markets, slightly bearish markets, slightly bullish markets. There's so much flexibility, which is why I've dedicated basically my whole life to option trading. And it's been the past 10 years of learning this on a deep level, as well as coaching so many students, which if you are interested in, it's just the first link in the description to join my Discord. Now, the fourth thing is option sentiment. When you buy a call option, you're betting that the stock price will go up. This is called a bullish sentiment. Conversely, buying a put means that the stock price will go down, known as bearish sentiment. Selling calls and puts means you can expect the stock price to remain below or above the strike price, respectively. Understanding sentiment is crucial because it guides your strategy. If you're bullish, you're looking at buying calls or selling puts. If you're bearish, you're going to be looking to consider buying puts or selling calls. Let's take an example. Suppose that you're bullish on Bank of America. Our current stock price is 30. You should buy a call option at $31 or $32 strike price that will expire in 3 months. If Bank of America stock price goes to $35, your call option will be worth more due to its increase in intrinsic value. On the other hand, if you're bearish on, say, a different stock, let's say ExxonMobil, that's currently trading at $110, you can buy a put option at a $100 strike price expiring in 1 month. If ExxonMobil stock ends up falling down to $90, your put option will gain value. Understanding these basic sentiments help you choose the right option strategy based on your market outlook. Look, when it comes to option trading, if you want to make money, you still need to have an opinion on the stock. If you understand the stock market, the option market is actually the same thing. It just gives you more flexibility with leverage, more flexibility with income, or more flexibility with hedging. So if you understand stocks, options are actually very easy to understand as well. Now, the fifth thing that we're going to be covering is the premium paid and received. This is very interesting because so many of my students are looking for safe passive income. They're looking to retire on option trading. They're looking for a secondary source of income. And when it comes to premium paid or received, this is very important. When you buy options, you pay a premium. This is the cost of entering the trade. The premium is influenced by various factors, including the current stock price, the strike price, time to expiration, and volatility. The premium you pay is the most that you can lose on the trade, which is one reason why options are considered a defined risk strategy. When you sell options, you receive a premium. This premium is credited to your account immediately. Selling options involves bigger risk because you might have to buy or sell the underlying stock at a disadvantaged price. However, it also offers you the potential for profit if the option expires worthless. Now, some of the strategies that I teach for selling options are something that I personally call non-losing strategies, meaning even if you lose or even if the option goes against you, you just take ownership of the stock, putting you in a good position if you like the stock anyways. So to put it simply, buying options, you pay a premium, your risk is limited to the premium that you pay, and the potential profit can be astronomically high or even in theory unlimited, because the stock can keep going up if you bought call options. If you bought a put option, well, the maximum it can go down is 0. However, there's obviously some drawbacks because when you pay money, you don't have income, you're expecting or hoping for a gain. Now, when it comes to option selling, you receive a premium. Your potential profit is limited to the premium that you receive. But your risk can also be significant, but in most cases, you are just putting up an X amount of capital, let's say $1,000, and then you're collecting $50 on the 1,000. So you have a very defined risk, which is $1,000 in theory if the stock went down to 0, which it won't, right? In the case of selling puts, in most cases, unless you're trading really bad quality stocks. This won't happen to you if you're trading high quality stocks. Then you have the return, the $50. So 50 divided by 1,000 will give you 5%. If you're able to do that on a weekly or bi-weekly basis, that's a really good return. So understanding how premium works is essential because it affects your potential return and risk. The premium is the price you pay for the opportunity and the profit from the stock's movement without actually buying or selling the stock outright. Now, number 6, we're going to be covering when selling options. When you sell options, you need collateral to cover your position. If you're selling calls, you need 100 shares of the stock per contract. If you're selling puts, you need cash as collateral. That's why it's called a cash secured put. This is crucial because if the trade goes against you, you may need to buy or sell the shares at the strike price. This is exactly where the term covered call and cash secured put comes into play. Now, covered calls, when you own underlying shares and sell call options against them, your position is covered. If the stock price sees a rise and the stock goes above the strike price, you're simply at risk to lose your shares. However, if you have sold a strike price that's higher than the current share price, you are probably pretty happy to sell the shares at a higher price anyways. Now, a cash secured put. When you sell a put option, you must have enough cash in your account to buy the stock if it falls below the strike price. This cash acts as collateral, ensuring you can fulfill your obligation if the option is exercised. Having collateral in place is essential because it protects you from potential unlimited losses. For example, if you sell a naked call without owning the underlying stock, your potential loss is theoretically unlimited because the stock price can just keep rising. We've seen that with a stock like NVIDIA. If you would have sold call options, you would be in big trouble. Similarly, selling naked puts can result in significant losses as well because if the stock price falls, you will have to take ownership of the stock. But if you don't have cash, then you're going to be taking ownership on margin. Margin can be very, very dangerous, and it is something that I do cover in my Discord community because it's a more advanced topic that, if you use properly, makes a lot of sense. I always tell students that if you have a pizza shop and you have only one oven and the line is out the door, it will make sense to take a loan to get a second oven. Last tip 7, understanding premium pricing. Every option has a premium, which is made up of intrinsic value, the actual value of the option, and extrinsic value, also known as the time value. The further out the expiration date, the higher the intrinsic value, and thus the more expensive the premium is going to be. Volatility also affects premium pricing. More volatile stocks have higher premiums due to the increased likelihood of hitting the strike price. Let's break down these components. Intrinsic value. This is the amount by which the option is in the money. For example, if you have a call option with a 50 strike price and the stock is trading at 60, the intrinsic value is 10. This is the actual profit that you would make if you exercise the option. Now, extrinsic value. This is the portion of the premium that exceeds the intrinsic value, also known as time value. It reflects the potential for the option to gain additional value before expiration. Factors influencing intrinsic value include time until expiration and the volatility of the underlying asset. So, for example, if an option is $10 in the money, but its premium pricing is $15, that's because $5 out of the $15 is actually extrinsic and $10 is intrinsic. Understanding how the premiums and the prices help you make informed decisions about which option to trade and which is actually a good deal or a bad deal. For example, if you expect a significant move in a stock, you might prefer options with higher extrinsic value despite their higher cost. That's because you realize that a stock might move a lot. Maybe it's an earnings event, or maybe there's some other news happening to the stock, and you think that the stock could go up 10, 20, or whatever percent. Then it actually makes sense to pay more for the option because there could be a really big move that could increase your option's value by multiple times. Let's talk about the bonus tip, which is the break-even price. Understanding the break-even price of an option at expiration is critical. The break-even price is the strike price plus the premium paid. If the stock price reaches this point by expiration date, you've never gained nor lost money. However, you can still profit or incur losses before the expiration. Because as I've said in a previous tip, you can buy and sell options when you wish. You can open and close them at any time. They're always changing in value. For instance, if you buy a Tesla call option with a strike price of 100 and a premium of, let's say, $1, the break-even price is going to be 101. And if Tesla hits the price by expiration, you are at your break-even. Well, Tesla's at $200 right now, so let's just say if it went to $200 and $1, if it went to 201, that would be your break-even. If it goes higher, then you are in profit territory. So if it goes to 205 and your call option's at 200 and you bought it for $1, well, basically, that's a $4 gain, right? Because you have $5 in the money, but you paid $1 for that option. Conversely, if the stock doesn't reach the break-even price, you might face a loss. In fact, you will face a loss at expiration of 100%. But before the expiration date, you will not experience a full loss, which is why for me, if there's a few days left or a week left and the option is still out of the money and it doesn't look like it's going to be in the money, I will cut the position and I'll try to lose not 100%, I'll try to lose a partial amount of the premium that I paid. So out of these 7 basics of option investing, there are several key points here that you really need to understand and keep in mind every time that you're trading. If you found this video helpful, please hit the like button and subscribe for more content. You can click over here to watch other videos, including how I made over $4.5 million using options.